Hey, you guys, ladies and gentlemen and ladies. Um, Today we're pleased and honored to have Ross Maxwell on the Trade Pod on our show, and we're so excited because Ross is a really interesting individual. We'll explore Ross in detail in of course his journey, how he trades, keys on traders, his cooperation, and we'll explore dive deep into his journey and how we build an incredible community of traders. And we'll
Yeah.
explore
So
everything about Ross and so on and so forth. This is going to be incredibly interesting. So stay tuned. Here we go. Ross, pleasure meeting you. Pleasure having you
nice
on
to
the
meet you.
Trade Pod. How are you
How are you,
today?
Rose?
Thank you very much, guys. Pleasure to be here. Thanks for inviting me.
Thank you for being here. Before we start, we like to start by identifying who we start with by understanding who we talk with. So this is your stage right now.
Yeah, all right. So, I've been trading the markets now for more than 20 years. I left school back in 2001, and just had a real deep desire to hit the financial market. So, I went straight into the City of London. Moved my way quite quickly from sort of back office roles into front office. I got my what was then FSA regulations, and started trading SAFEX futures and options, so the South African Futures Exchange. So yeah, I spent quite a few years doing that. I moved to Hong Kong in 2010. Spent a few years there as well before coming back in 2013 and back to London, all working for the same company. And then decided in 2014 that I wanted to try it on my own. I didn't want to be tied into sort of like the city life anymore. I wanted to work for myself, get some more flexibility, freedoms and stuff like that. I was still young enough. At the time, I didn't really have the family commitments that I have these days. So it was a good opportunity for me to sort of like take that leap without those sort of like responsibilities and things like that. And fortunately for me, it's worked out and sort of like never looked back. So I started day trading in 2014. And yeah, sort of progressed through, developed as a trader. I started in 2017, worked for another education company, sort of helping develop their syllabus and mentoring their traders and their clients. And then in 2021, having done that for a while, I had a real deep enjoyment and passion with working with other traders, seeing the issues that they faced and sort of helping them overcome. I felt like it not only could I pass my own experience on, but I actually learned a lot from that as well, going through what they're seeing, what other people were dealing with, and wanted to sort of like take that on my own. So I decided to go alone and set up Keyzone Traders in 2021. And the rest, as they say, is history at the moment. So still going strong as a trader, still going strong as a mentor, and yeah, loving every minute of it.
That's the most
So super
important.
awesome. Yeah, you had an incredible background. Looking backwards, 10 years ago, you have started with your career in day trading, and in 2017, you have joined a company that helps people around the world, as far as I understand, to help traders and to enable them to grow and sustain themselves within the markets. So, what happened during the years between 2014 to 2017, and what got you to help traders? So, what have you discovered back then that you wouldn't discover if you weren't inside that period of time in between?
Yeah, so I mean, look, 2014, 2017 was really sort of like me developing myself as an independent trader. The life and the experiences. So obviously, having worked within the city and within that sort of environment, I had a real deep knowledge of how the markets worked, what like how to read the markets, etc. But actually switching to the other side and becoming an independent trader is a whole different ballgame. Like you have access to different information. You don't have access to the order flow like you do when you're working within the city and talking to like the institutions and the banks and stuff like that. So you've got to read the market in a very different way. But the main difference was sort of like the emotional mindset side of things. You know, I had someone actually ask me not too long ago, like how did I cope with the emotional aspects of like trading like tens of millions of dollars worth of capital in the city of London. And I sort of like tried explaining to him like I dealt in massive size when I was working in London, but trading that first trade with my own money at a fraction of the amount was much more emotional, much more difficult from a mindset point of view than it was trading
Really?
it for somebody else's money. Yeah, 100%, because you've got your own, you have your own attachment to that money, right? So it's your money on the line, your decision, you're purely responsible for that thing. And whether I made money or not in London, I still got paid. I still got a salary at the end of the month. Whereas in trading for yourself, you can go to work and you may have to pay to go to work because you can lose money on any particular day or week or anything like that, or any particular trade. So it's a real mindset shift and actually having to cope with that. So I think those first sort of 3 years was me developing that sort of side of things. I really focused on the mindset, the emotional side of things, really got into sort of like meditation and mindfulness, and really helped that develop my sort of like my trading, that side of things. But also, like I say, wasn't as big a shift, but there was that element of really having to understand how to identify the edge in the market when you don't have as much access to information as you did when I was working in the city.
Let me interrupt. Let me interrupt for a quick second. You mentioned that you have started your independent trader journey back in 2014.
Yeah.
Till 2017, you have discovered, and you took 3 years period of time to understand how the market works without order flow. So first question would be, what instruments have you traded back then when you was trading for a trading company that enabled you to look at the order flow? And what instruments have you traded after leaving and starting your independent trading career? So having the need to understand the market without order flow and discovering the edge of how to read the markets in particular helped you. Like, how do you find an edge? Because you looked at the order flow back then, you didn't look at the order flow when you were just started as an independent trader. What was the differences between the two? Between
Yeah,
the two periods?
so back when I was trading in London, my main focus was on South African futures and options. So it was emerging. I worked on an emerging market equity derivatives desk, was the actual desk that I worked on. My focus was on mainly South African futures and options.
Those assets are liquid, by the way.
Yeah, they're pretty. I mean, not as liquid as sort of the FTSE or the DAX and things like that. But yeah, we trade in decent size, and yeah, relatively liquid products.
As a market maker.
Sorry. Yeah.
As a market maker, you have traded the
No, I wasn't a
African
market. No, I wasn't a
contract.
market maker. I wasn't a market maker. So the market makers and stuff were my clients, and the institutions were my clients. But I was working with mainly South African futures and options. We did some forex and that side of things, but it was my main focus was on South African futures. When I switched into day trading, so I remained focused on sort of equities because that was where my background was. And initially, I focused on the DAX and the FTSE and the S&P 500. So those highly liquid, main traded asset like instruments. As my trading has gone on, I do more FX and stuff now. I still deal with the indices, but I do a little bit of FX as well. And I think just to clarify one thing, what I'm saying when I transitioned from having the order flow or knowing the order flow within the market from the institutional side to developing my skills to read the market from an independent side. Basically, what I've managed to do over the period is to be able to identify where the order flow is through my technical analysis. So beforehand, I didn't really need to have those skills because I knew where the order flow was just from speaking to the clients and getting those orders. But being able to read the markets, read the technical charts, read price action to be able to identify where the order flow is. That's sort of like the skill that I've developed over the period.
So price action as a price action.
Yeah,
Japanese
exactly.
candle as a Japanese candle.
Yeah,
No
but
flicker charts.
Yeah, but I don't necessarily look at individual candles. I don't think like looking at one individual candle pattern or sort of one candle in any isolation really gives you too much information. It's one pattern in. Sorry, excuse me, one second. So yeah, I can't remember where he was. We was talking about.
So we were talking about price action in general and how
Yeah.
everything got to get clear. Now I would like to ask you, just looking at price action,
Mhm.
um, understanding you're speaking about understanding how edge is like how you define an edge looking at price action. So basically, I would like to understand how would you define an edge just by looking at price action, and you told us that you find the order flow within the price action itself without really looking at the price action. So how do you or how do you practice yourself or exercise to be enough experience in order to see the order flow behind the candlesticks
Yeah.
that will enable you to have an edge over the markets?
Yeah, so I mean, it really boils down. It sounds relatively simple. Obviously, it's much more complex in terms of building the skills than it actually sounds. But really, it's just mastering support and resistance. So once you understand that it's the institutional order flow that moves the market, it's not a particular candlestick pattern. It's not any one thing that actually moves the market. It's the institutional order flow that moves the markets. Then you can actually identify where those swing points in the markets are, like the really sort of clean areas in the market, the ones that would produce really strong reactions. That's where the institutional order flow has stepped in. And when you see that repetitively over a period of time, you know that's the area that the order flow is regularly hitting the market. Therefore, you already have you know your edge, because you know that those are the places that you want to be entering the market. So that's where you actually should be placing your entries. Everything else is just chop. So everything, and this is where a lot of traders will, retail traders and the traders that I've come across and coached, lose a lot of their money. So they can have some really good periods of time, but then they get caught out in this sort of like this really range-bound, choppy market, and they just get chopped out within the middle and just lose all of their money there. But actually, if they show the exercise, the patience, so they identify the edges of those ranges where the institutions are actually stepping in, they wait for there to enter the markets, that's where they can create the edge. So it's a little bit more complex than that, like understanding the actual price action in terms of the order flow, in terms of impulsive corrective price action, what sort of phase of the market you're in, what sort of structure you're in, whether you're in a clean structure, unclean structure, but then also having the exercises and the discipline and the patience to, once you've identified these areas, to wait for the market to move into those areas as well. That's what sort of really creates the edge, is like putting all of that together. So the basic fundamental thing would be to identify the key zones of support and resistance, which is where the institutions have moved the market. And then the rest of it is understanding the price action and having the mindset and the patience and discipline to actually wait to execute it.
I got it. Wow, that was a really comprehensive answer. Honestly, I didn't expect that comprehensiveness and understanding how the market actually works. So, speaking about market mechanics, I would have to ask you, what do you think about that whole trend that has been created, that called ICT, SMC? Because, like in particular, they those are supply and demand strategies. Like they look at a supply, they identify supply or demand zone,
Yeah.
and based on that, they have built, I have to say, a really comprehensive and state of art strategies.
Yeah. I mean,
Some of them might work incredibly good. And most of the retail traders, once they enter to the market using those strategies, they lose.
yeah.
So first of all, what do you think about ICT SMC? By the way, this is only a personal thoughts. This is not a recommendation. This is not I don't know, any type of discrimination to the brand. Just a personal opinion.
Yeah.
And how do you approach a strategy like this if you were like with your experience that you have raised over the years?
Yeah. So, I mean, look, ICT and SMC concepts, like, look, I hear them talked about, I get clients coming to me all the time and they've sort of like looked at them. Personally, I've never studied them from my own personal point of view. So I couldn't necessarily really offer a real proper opinion, personal opinion on it because I've never used them. I've never studied them. I think generally speaking, the concepts are fairly solid. They're fairly sound in terms of like how the market works. And I think if you can understand them, I don't have any sort of issue with the way that they teach and the ideologies that they teach. But I think you've really touched on a really important point. And I think it's you sit there and say, these strategies can work really well, but then somebody takes them into market and they don't work. And I think it's really important to identify that it's not always necessary. Like there are actually a lot of strategies out there that have an edge, but it's the application of the strategy through the mindset, the risk, the discipline, all of those sorts of things that will allow the strategy to play out its edge. So actually, sometimes, and this is the problem where a lot of retail traders look for the holy grail, not necessarily the holy grail, but they give up on strategies quite quickly, and they think it's a strategy that is the issue when actually there may be something deeper within their risk management or their mindset or the application of the strategy is the issue rather than the strategy itself. And likewise, just because one strategy works for one trader doesn't mean to say it can work for everyone because everyone has their own identity. So you need to find your own identity as a trader. As an example, I'm a day trader. The reason that I'm a day trader is that if you gave me like some sort of longer term swing position holding strategy, I would meddle with it too much because I'd be checking my phone, I'd be watching it every day, and my emotions would take over and make me meddle with that and not allow that to play out. Likewise, a scalper, I'm not necessarily quick thinking enough to be able to react in and out, and I don't like taking loads and loads of trades in any one particular day. So the style of trading and the style of strategies that suit me as an individual is the sort of day trading strategy. So I think that's where just because a strategy doesn't work, not necessarily is a problem with the strategy. It's just you've got to try and find yourself as a trader and try and find the strategies that work with you, but also identify the real real issue behind why your performance may not be profitable. And it's not necessarily, sometimes it might be the strategy, and you've got to work that through the market and get the data to make sure that the strategy doesn't perform for you. But actually, if you see repetitive behaviors in your performance through your trade journals and your analysis, then you need to focus on that and improving that rather than necessarily changing the strategy.
I understand. So basically, you're speaking about you know what? You have mentioned like some incredible insights within that answer, but I want to take my perspective onto one sentence that you have mentioned that each trader develops his own identity in trading. So meaning if we're taking the same strategy, me and you, Ross, and Alan as well. So all three of us take the same strategy. Now, for this hypothetical situation, let's use a simple Bollinger Band strategy. We might attack the trading strategy in three different ways. And what do you think upon your experience, like talking to hundreds, even thousands amount of retail traders? What do you think that is the differentiates between everybody, and why people consume the same strategy differently?
I think it's just human nature in the sense of like how we consume it differently, right? It's interpretation. It's fairly subjective. Like trading in general is quite subjective. And I go back to sort of like the support and resistance zones that I teach to take it away from the like a Bollinger Band strategy, but even the support and resistance zone strategies and stuff that I teach in my concepts. The one thing that I sit there and say to my traders is and my clients is like I give out analysis, I give out my zones on a daily basis to the clients. I do my chart analysis and I put it out there. Now, just because another trader may have that zone slightly different doesn't mean to say I'm right and they're wrong. As long as we're in the sort of same areas, then we're along the same lines and we're okay. It doesn't have to be exact. So it's subjective in nature. So just by the fact that it's subjective in nature means that people are going to interpret it slightly differently. Same with trend lines and channels and this sort of thing. Like it's all subjective in nature. It's not some sort of linear binary decision when you enter the market. So I think that is where the differential comes in. So yeah,
I think that's the beauty behind it.
yeah, yeah, totally agree, totally agree. And it allows people to express themselves as well within the markets.
So regarding risk management, um, so how do you integrate, like, let's say, how do you integrate risk management into your price action trading strategies, ensuring long-term stable profits for yourself and also for your clients?
Yeah. So I think look at it. The one thing that I think you have to like, one of my key foundations is risk management. Like if you can't risk manage, if you can have the best trading strategy in the world, if you do not manage your risk properly, then you're going to blow up your account. You're going to end up, as really harming your account. So rule 101 is understanding risk management and also understanding how much you should be risking per trade, dependent on how that changes depending on your trading style. So, for example, if you're a scalper that's trading sort of 20 times a day, you should be risking much smaller amounts than a swing trader who only trades a handful of times a month. So it's really understanding the overall risk that you're putting onto your account in terms of the size of the trade, the number of trades, the frequency of trade, your risk appetite, the capital that you've got available, and those sorts of things. So in terms of how I do it, and also the other thing to really make clear is if you have a strategy that has a statistical edge, and this goes way back to like taking it back to basics, like Michael Douglas trading in the zone sort of thing. If you have a trading strategy that has a statistical edge, you have to risk the same amount on every single individual trade. Otherwise, you're not going to let that edge play out. Even if you have a hit rate of 70%, the distribution of those 70 winners out of every 100 trades is going to be completely random. We can't sit there and know which 70 are going to be the winners and which 30 are going to be the losers. So the only way to allow the statistical edge to play out is to risk exactly the same amount on every single trade. So it's first of all identifying an amount that you are comfortable with, that you can go through a drawdown, go through a losing run, and still consistently follow the same process and follow the same risk amount, but also adjusting the risk according to the strategy in terms of its frequency. So you know how much, like, again, there's no point as a scalper who trades 20 times a day risking 2% of your capital on every single trade, because you're putting 40% of your capital at risk every single day, which is just obscene. If you have like one or two off days, you can really do a lot of damage to your account. Whereas, if you're doing a handful of trades a month because you're swing position trading, you can risk 2%. I personally don't advise people to risk anything more than 2%. But 2% when you're only trading 5 times a month, you're not putting too much of your account at risk at any one time. So it's really trying to understand. So me personally, I trade sort of like on average somewhere around sort of 15 to 18 times a month. So I'm happy risking 1% per trade because I'm comfortable with that amount over the course of a month of my capital being put up. Back when I started, I would risk higher amounts when I was trading a smaller trading account, and maybe I didn't have as much experience on the risk management side of things. But as I've developed and really compounded that, it's sort of like, I've reduced the risk and I risk consistently 1% on every single trade.
I got it. And I would like to ask you, like, based on like your statistical approach, you need to risk the same amount every single time. Um, and and like, as a human, you're not capable of risking the same amount every single time. So I would like to ask you, how would you build a comprehensive risk management system that, like, individually work for that particular sense, that particular strategy, in order to remain resilient and profitable eventually with this trading strategy. So, what is your checklist in order to build a comprehensive risk management that would perfectly fit to the strategy itself?
Yeah, exactly. I think you've hit the nail on the head. Really, just it is basically a checklist. You need to have a detailed trading plan, and if you have a detailed trading plan which outlines exactly, you basically almost need to make it robotic, right? I know you sat there and said, like, as humans we naturally can't risk the exact same amount on every single trade, but as long as we're very close, like it doesn't have to be, exactly £100, exactly £200, exactly £500, but as long as you're within 10% of that, then you're close enough. And I think it's just like now I've got myself into a thing where it doesn't even enter my head that it could be anything different than 1% of my account, because it's just become so ingrained in my subconscious that it's just like a natural part of my trading process that I risk 1% of my capital on every single trade. So by listing it for 10 years in a trading plan, and for doing it day in, day out, following that thing and actually putting the processes in place, like through, mindfulness meditation, whenever I strayed from my trading plan, I would visualize myself redoing it, doing it properly. All these sorts of things have just really ingrained it in my subconscious that it's just become a natural part of my being that I risk 1% on every single trade. Now, there isn't any magic wand that you can just wave and sit there and say, and this is what, if there was, if you could just watch a YouTube video, or you could listen to a podcast, or you could just read a book, and you could just risk 1% per trade, nobody would have any risk management issues, but that's not the case. So again, it comes back to the mindset thing. You really need to focus on your mindset. And it comes back all the way back to that thing where I said it's not necessarily the strategy that's the issue. It's focusing on what the actual crux of the issue is. So if you through your analysis of your trading, which everyone should have a trade journal, because it's the only way that we can analyze our trading and make and improve as traders. If through that we realize that we're not risking 1% on every single trade, and we're straying from that, and our trading plan says that we should be risking 1% per trade, well, actually, the issue is not the strategy, it's the fact that we're not risking 1% per trade. So we need to identify that and then work out and put something in place to rectify that. Now, that can be mindfulness visualization, some sort of reward chart, some sort of, whatever works for that individual. There's a multiple of different sort of techniques that we can put in place. But ultimately, that's the thing, and that's what you've got to work on. And there is no magic wand, as I say, but you just need to put the hard work in and just repetitively do it. And eventually it does become part of your subconscious, and then it becomes part of just your process.
All right. All right.
Regarding psychology, by the way,
yeah.
Can you share an example of a mentee who struggled with mindset issues?
Yeah, 100%. So when I first started coaching, one of my first clients was actually a guy that had been trading for 10 years. He'd lost over £100,000 in trading losses. And again, it wasn't his technical ability to trade that was the issue. He could trade 3-6 months quite comfortably and make really good returns, and then he'd just lose it in like one position, 1 week, one really bad period, get on tilt, as they say in poker, get the emotions, just hijack his decision making, and he'll blow up half his account in like one short space of time. And I worked with him over the course of 18 months, and it was like, these episodes, these drawbacks, these sort of mistakes, they continued to happen, but they happened less frequently, and when they happened, they were less damaging. And it was just trying to make him realize that, yes, he's still having these setbacks, but it's still progress. It's not like it's like an addiction, right? It's like any sort of anything. You don't just go cold turkey and like say these mistakes are never going to happen again, because if you think like that, when you do make the mistakes, you think you're a failure, and that's not actually. As long as you can see progress, you're still improving. And I remember it happened once, and I was almost literally at a point where I was like, I've given you every bit of advice that I can. I'm not really sure where we go. I said the only other thing which I've been talking to him about for like 18 months, and he'd resisted it every single time, was mindfulness and meditation before you sit down to trade. I'm a massive believer that it can really help those with mindset issues. It can transform your trading, is mindfulness and meditation before you sit down for a trading session. And he embraced it from that. And from that moment on, he has now been a profitable trader. He's like literally, he's never missed a day. I spoke to him literally last month. He's never missed a day. That's in about 5 years that he's been doing it. Never missed a day of mindfulness or meditation, and he's been profitable for those 5 years. And it was just that shift. It wasn't his technical ability to trade that was the issue. It was that he didn't have control. He was every now and then he would allow his emotions to hijack his decision making when he's trading, and yet the mindfulness and meditation was the catalyst for him to be able to control those emotions and not control them, because that's the wrong word actually, but it was the catalyst for him to be able to identify his emotions before they hijacked his decision making when he was trading.
Wow.
Because what mindfulness and meditation does is it sort of allows you to appreciate that, you know, there is an emotion there, but all emotions temporary. All emotions are temporary, right? We never stay angry, we never stay sad, we never stay happy forever. So it will come and it will pass. And it's like it's identifying that there's an emotion there before the intuitive side of our brain reacts to it and puts us into a position that we didn't want to be in, like an inopportune position that we didn't want to be in, and therefore it stops us reacting to that, allows us to sit with that emotion, allows it to pass, and then we puts us back into a more rational state to make a better decision.
Yeah. So you transitioned from a long career in institutional trading to becoming an independent trader and coach. Now, what were some of the challenges you faced? Well, we talked about this, but I also want to ask you, how would you advise someone else that also would want to take this path from institutional trading to independent trading? Because you do need to, well, there is challenges. I mean, still, you lose all the information that you had. You start with a blank page.
Yeah. I think the main thing is to not have an ego, like not to think just because you're in the markets and you have a really deep understanding of the markets already that you're going to just be able to make the transition very smoothly and, you know, make money from day one and, you know, just like carry on. I think you have to realize and you have to respect the markets. You have to respect the fact that, you know, you are going up against professionals every single day. You're going into a marketplace where there's professionals who have spent their whole career perfecting their skills and honing their skills. And I think it's just give it the respect that it deserves. Educate yourself properly. Give yourself time to adapt, to make the adaptations that you need. And again, it comes back to like the analysis of your performance. Like just constantly analyze your performance. Look for areas of weakness. Look for areas that you can improve on. Look for the areas that you're falling back on, and just attack those areas. Identify the areas, and then put some process in place. Focus on something that can improve that area of your trading. It's like anything. It's not just trading. This is life in general. This is like
it is
sports and everything. You know, like I remember reading an article once, and it was from a youth tennis coach, and it was like we know the ones that are going to really make it, not because of their natural ability at a young age, but it was the ones that saw their weaknesses, identified them, and saw them as a strength to actually improve themselves as a tennis player. And it's the same as traders. If you just think that you're going to go in and be able to, you know, trade the markets because that's what you've been doing, you're not looking for self-improvement. So you need to be able to, give yourself the time. And I think one of the biggest things in trading, this isn't just from moving from the financial markets from an institutional financial situation into an independent trader, but this is just in general a trader's life. You know, society teaches us go work 9 to 5, get paid at the end of the day, at the end of the month, at the end of the week, whatever your contract is. And as traders, that's not the reality, right? So it's shifting your mindset, shifting your mentality, shifting your whole structure on how you pay yourself, we still have bills to pay, we still have mortgages, we still have like holidays to pay for. I've got as you saw, I've got young children that's like I need to provide for. So it's making sure that you're structured in a way that even when you hit a drawdown period, you can pay your bills and continue to trade in exactly the same ways you have done before, without it affecting your ability to generate revenue through your trading. And that's sort of like, through like having buffer funds and things like that, and having certain amounts, only paying yourself X amount out of your profits, even if you make, say for example, I sit there and say I need, £5,000 a month to live on. If I make £10,000 in my trading that month, I should still only be taking £5,000. I don't take £10,000 and go on a holiday. I take £5,000 because the next month I might lose £3,000, and I still got to take something from that to be able to pay my bills. So it's just having that, like, shifting that mindset, I think is really key. Again, not just from the initial switch, but just the switch in general to trading full time.
Cool. And how do you deal with volatility?
Yeah, I mean, look,
Like its
volatility.
effects, I mean.
Yeah, and I mean, look,
Whatever.
a lot of people always come to me and sort of sit there and say, like when the market, like through COVID and like the when Russia started its war in Ukraine, it's like, oh my God, like you must be really struggling. Like, as a short-term trader, I'm not, because I can go long, I can go short, I can take advantage of all price movements within the market.
So you have options, like.
Well, yeah, I'm not an options trader, but when I sit down at my desk every day, because I'm only taking an intraday bias, I don't have any position, so I don't have a bias in the market. When I actually sit down at the desk, I'm looking to establish my bias for that trading session. So whether the market's going up, whether it's going down, I can profit from those price movements. Obviously, if you're taking a longer term view, those can be really painful times to sit there when you see your portfolio going down and down and down. But you've got to have that sort of like the emotional intelligence to be able to understand it.
But how do you switch the lifestyles? Let's say lifestyles, right? So you're also a swing trader, but also a day trader. So how do you mix them together?
Well, that's a very good question, because your mindset for both has to be very different, right? So I think initially I would sit there and say you have to have you need to treat them as two separate strategies or two separate trading systems. Maybe you have two separate accounts, so that you have your day trading, which is like, so and this is the thing, right? So day trading is much more of a revenue generator. It's much more of an income generator. So it's like to generate an income for you to spend money on, whereas longer term trading is much more of a wealth builder. So you're looking for longer term wealth generation rather than, a monthly paycheck. Whereas like day trading is a little bit more sort of like you're looking for those short term profits to generate an income from. So I think it's important to differentiate the two and maybe have them on two separate accounts. One, obviously, day trading takes up a lot more of your time. It's much more time intensive than sort of like your swing trading. So I think it's important to differentiate the two, for sure. And I think from a mindset point of view, it's just making sure that when maybe like you separate the two when you're focused on the two. So my trading hours are between 8 and 10 o'clock in the morning in the UK, and then 2:30 to 4 p.m. And if I was going to be swing trading as well, I shouldn't be swing trading between 8 and 10 and 2:30 and 4 o'clock. I should be solely focused on my day trading in those periods, and I do my swing trading at a separate time. So I'm purely focused on that strategy rather than trying to mix up the two and then get confused with it.
But when you're just starting out, you should focus on one, right?
Yeah, 100%.
Or a day trading or a swing trading.
Yeah, I think really, when you're just first starting out, I think you focus on one style of trading, maybe even down to like one asset class. If you're a day trader, maybe even just one instrument. Execution on one time frame. Don't overcomplicate it. I think a lot of people do try and look at everything all in one go, and they overcomplicate it, which again just creates this sort of cognitive fatigue, which then leads to mistakes and stuff like that. So yeah, I would really advise one trading style, and maybe, like I say, maybe even just one asset class. And if, like, when I very first started, I was really focused mainly on the FTSE, and then a little bit of DAX, and I think that really helped as well, because it really just helped you focus on one thing, develop the skills, and then transition them out from there once you build them up.
Yeah. And regarding regulations, I don't know if it's the most relevant question, but how do you advise traders who may want to navigate the different regulations of different global markets?
Yeah, I mean, look, so I mean, obviously, with as a retail trader, you don't have to be regulated to trade the markets. I think, I think that's a key point to make. Which I think there should be a lot more regulation in the retail space. Personally, I don't think necessarily it's a bad thing. I think it can protect the retail trader a lot. I mean, look, if you're, I think the one key thing to really look out for in terms of regulation is if you are putting your funds anywhere, you need to make sure that that broker is regulated by a reputable body, like by the FCA, by the SEC, by the ASIC, or something like that. In terms of regulation from a retail point of view, I think that's the main thing. Like I say, from that retail point, and make sure you're trading regulated products, right? And again, it comes back to when you're really starting out, you really want to be focusing on liquid instruments, because they're much more forgiving when you make mistakes. And I'm not saying they're totally forgiving; you can still lose a lot of money, but you know, if you're trading liquid instruments and regulated instruments, then it's going to be it's going to be much easier for you to learn and develop your skill sets and stuff. So I think just from that sort of side of things, depending on where you are in the world, depending on which broker you are, just make sure, just do your due diligence, check their backgrounds, do your homework on them, and I mean, there's this whole thing with like the limits on margin here in the UK, with like from the professional and retail status, where you get reduced margin, reduced leverage, and that sort of thing. Personally, I think it's a good thing, because again, it protects people, and it stops people from risking irresponsibly. So I actually see it as a positive, because it's there to protect you while you develop your skill sets. I think it's just
Ross, any last advice that you would give to anyone? Literally, anyone?
I think, look, I think enjoy the ride. It really, really respect the markets. You know, I think, as I said earlier on, we're playing with professionals here, so you have to give it the respect that it deserves, which means you've got to educate yourself properly. And don't just focus on strategy. Look at your mindset as well. Really, like I think you learn a lot. I think you learn a lot about yourself as an individual when you start trading. Again, even if you're not going to take it as want to take it as a profession and really sort of like take it as a full-time income, even if you just want to do it as a hobby, you still need to show it the respect that it deserves. Focus on risk management. Like if you don't learn how to manage risk, you will not make it in this game. So I think that's probably the one big piece of advice I would give is focus on risk management, look at your mindset, and give it the respect it deserves.
Ross, thank you. Really, it was a pleasure.
Thank you very much. I really enjoyed it, and thanks again for having us.
Definitely. Bye bye.
Cheers.